Good day, ladies and gentlemen. So today I want to teach you the difference between a breaker block and a mitigation block. Okay, this video is actually inspired by a comment I got in my comment section in one of my videos, where a subscriber actually asked for the difference between a mitigation block and a breaker block. Okay, so if there is any concept you don't understand, you can ask me in the comment section so I can also make a video in order to explain that particular concept. So without further ado, let's jump right into it. Okay, so the very first thing you need to know is an order block. Once you understand what an order block is, then understanding what a breaker block and a mitigation block are is going to be very easy. Okay, so an order block is simply the last opposite color candle before an impulsive move. Okay, I've talked about this before. Alright, so the last opposite color candle before an impulsive move in a particular direction. So if this were to be a bullish impulsive move to the upside, this last bearish candle is what we call an order block. So we are looking for price to come back there and then we take our trade. Okay, so basically that's what we call an order block. Alright, so what then is a breaker block and what is a mitigation block? I'm going to explain breaker block first, then I'll explain mitigation block. Okay, so both of them are similar. There is just one distinct difference between them. Okay, so a breaker block is an order block that has failed. Alright, so let's say for example price is moving in an uptrend fashion. Okay, let's say move this a bit. Okay, so let's say price is moving in an uptrend fashion like this, creating higher highs and higher lows, for example. All right, okay, so at this level right here, you could have a bearish candle. Let me turn this to red. Okay, there could be a bearish candle exactly at this level. Pay attention to the line drawing I'm making. Okay, so you have a bearish candle right there before this impulsive move to the upside. Okay, so along this leg there's a bearish candle, so that bearish candle is an order block. What makes it a breaker block is when price comes down and then breaks through it. Okay, when price comes down and breaks through it, that makes this particular order block become a breaker block. So what will happen is you're gonna wait for price to do what? Wait for price to retrace into the breaker block level and then you take a sell trade. Okay, this for a bearish breaker block. All right, now one thing you need to take note of is that for a bearish breaker for a breaker block, liquidity is taken from two positions. The first position is this particular high right here. Let me redraw it so it doesn't look messed up. Let me redraw the system. So you have this, price moves like this, retraces, and then gives you an upward move like this. So along this leg, the last, let me draw it again. Sorry, I want it to be very clear. So okay, so you had a move like this, and then you had this, and then you have this. Along this leg right here, you had a bearish candle, okay, which is an order block right here. Okay, now liquidity resting above this high was taken by the impulsive move from the order block. Okay, that's the first liquidity that is taken. This is like the major characteristic of a breaker block. Then price comes down and takes the liquidity below the order block by going below it like this. So there are two liquidities taken. One is above this high, okay, then the other is below the order block. So for price to have come below the order block, then you have a breaker block. You can see that an high was taken, then price came down and went below the order block, taking liquidity resting below that level. Okay, then from here you wait for price to come here, then you sell. All right, so that's the characteristic of a breaker block. This is a bearish breaker block. you have the other way around when you are dealing with bullish breaker block. Let me give you a bullish breaker block. You have price moving in the downward direction like this, and then you have this. So along this leg right here, the last bullish candle along this leg right here is an order block. Okay, so you can see that liquidity below this low was taken when price moved down below the low. Then price moves up and goes above this order block, taking the liquidity resting above the order block. Do you see that? So we are going to wait for price to come back to this breaker block. This is now a bullish breaker block. We wait for price to come back to this breaker block in order to take a buy trade. Okay, so the main difference between breaker block and order block is that, between breaker block and mitigation block is that for mitigation block only one liquidity is taken. Liquidity of you don't have two liquidities taken as you have it in breaker block. Okay, you will understand what I just talked about when I explain mitigation block. So let's go to mitigation block. For mitigation block now, let's say price was moving in the upwards fashion like this, then you have this pullback right here like this, and then you have something like this. Notice that this particular high was not taken, then price crashes down like this. So there is a last bearish candle along this leg, okay, which pushed price up. But it pushed price up to the point that price did not break this high. Then price collapsed, taking the liquidity below that level. Now what you have here is a mitigation block. Okay, so this is a mitigation block. You wait for price to come back there, then you sell. I have live examples. If you don't understand the way I'm explaining it like this, when I go to the main chart example, you are going to see the clear difference, but try to follow. Okay, for mitigation block, the price movement would have gone above this level in order to take the liquidity resting above before collapsing to take the liquidity resting below the other block. Okay, so but for mitigation block, the high is not going to be taken, and if it's the other way around, maybe you are looking to when it's a bullish mitigation block, the low will not be taken. So let me quickly give you a bullish mitigation block. Price moves this way, comes up like this, okay, then instead of breaking this particular low, price comes this way. All right, there will be a bullish candle somewhere here which push price down, but it pushed price down to the point that price did not break this low. Then price zoomed up, okay, breaking through the order block that was there. Now that order block automatically becomes your mitigation block. So you're going to wait for price to come back there in order to take a buy trade. Very, very simple. So that's just the concept behind it. So both of them are similar. Both of them are like they are order blocks, not as if they are actually order blocks that failed, but they failed in different formats. Okay, when the order block, which turns into a breaker block, failed, you had two liquidity levels swept. Okay, but when an order block, which is going to turn into a mitigation block, fails, all you have is one level of liquidity swept. Okay, the liquidity of the low or high is not going to be swept. That's the major difference. So let's go to the live chart. I have two examples marked out for you, and they are very close to each other, so it's going to make it easy for you to see the difference between them. Okay, the examples I marked out were very, very close to each other. Okay, so these are the two examples that I marked out. So let me zoom in a bit. Okay, good. Now notice what was happening here. Do you see that price was moving in the upward direction, for example, creating higher highs and higher lows? Then we got to this point right here. Look at this last bearish candle. That last bearish candle is an order block, because after the bearish candle we saw a move to the upside, which was signified by two bullish candles, showing you that buyers were interested at that particular level. So there's an order block there, okay, and the bullish candles did something significant which defines a breaker block. What did the bullish candles from that level do? The liquidity above this high was taken. Can you see that? The bullish candles took the liquidity above that order block, okay. So the high right there was taken by the bullish candles, okay. After the high was taken or swept, what did you see happening? Price then collapsed, going below this particular order block. So 2 levels of liquidity have been taken like that. All you just need to do is to get 2 horizontal lines and place them on that order block, because, ladies and gentlemen, it is now a breaker block, okay. It is now a breaker block. So you simply wait for price to come in there and then you take your sell trade, okay. So if it were to act as an order block, when price came back in here, price was supposed to give you an opportunity to buy, but instead price broke through it, okay. So it's now a breaker block. We are looking to sell from that level, okay. Hope it's clear. So that's a breaker block. Now for an order block, for a mitigation block, look at what happened. Price moved down, came up here, did not take this high. Can you see? This level of liquidity was not taken. Then price collapsed in the downwards direction. So this bullish candle right here, this bearish candle rather, this bearish candle right here that pushed price up. Can you see the bearish candle? That last bearish candle is an order block, because buying took place at that particular level, okay. So buyers were interested. The buyers pushed price up, but they did not push it up to the level of breaking this high. That's the reason why it is not a breaker block. Assuming it broke this high, then came down to collapse below the other block, then it is a breaker block. But as price moved in the upward direction, it did not take out the most recent high, which is this high here. It didn't take it out, it just stopped somewhere, then price collapsed going below that level. So what you have here is a mitigation block. All you just need to do is draw 2 horizontal lines, on that particular mitigation block, and you wait for price to get back there, then you sell. So let's see. Look at what happened. Price got back here, price got back to that level, okay, got back there and gave us an opportunity to sell to the downside. So the reverse is the case when you're also dealing with bullish bullish breaker block and bullish mitigation block. So I hope with this example and explanation you can actually understand what the difference between a breaker block is and a mitigation block. They are kind of similar, but the major difference between them is that for mitigation block, only one level of liquidity is going to be swept. The most recent high or the most recent low is not going to be swept, okay. While for breaker block, 2 levels of liquidity must be swept, okay, before you can call it a breaker block. All right, so if you got any value, please subscribe to the channel and turn on the notification bell. I'll see you in the next video. Thanks for watching.